Happy Friday, everybody. Office hours are open with Professor Mark Guthner of Rutgers. He's joining us today, and we've got meta earnings coming up next week. So plenty of things to talk about today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome, of course, as always, to our good friend and colleague, Professor Mark Guthner. Mark, how are you?
I'm doing well. Life is good, and the weather's getting warm out here finally, so spring is here.
Yeah, our weather also has been warming up a little bit. I've had a number of people reaching out to me saying, "When are we getting back out on the tennis court?" And I have all of my extra winter pounds to shed, so I'm trying to figure out how to get into it slowly, so I don't do what I did 2 years ago coming out of this. I got out, went hard, popped a calf muscle, and then was immediately out for 4 or 5 weeks as I nursed that back to health.
Well, I'd go on an all-protein diet for a while and see what happens.
Yeah, I'll give that a try. So I guess my first question for you, we've had, all of the zigging and zagging that's been going off on the tariff front. We got a few more this week. And actually, it wasn't just that, right? So we had everybody's gnashing of teeth last week because Donald Trump was highly critical of Powell not lowering interest rates.
Yeah.
And I know you pay a lot of attention to monetary theory, so I was going to just ask you, first of all, what are your thoughts about presidents trying to sway the chairman of the Federal Reserve?
I think they all do it. Some are more vocal than others. Maybe they have the conversation over a breakfast to, let their position be known. And I don't know of a politician who said, can you raise interest rates for me, please? Come on, man, you're killing me here. So I don't think that's ever happened in the history of the Federal Reserve. So they're all doing it, even if the ones that are quiet, they're just using the back channels to have the conversation and see what they can go. And we see the Fed and the federal government coordinate all the time. They did it just recently during COVID. The government said, "Hey, we're going to go issue, what was it, $6-7 trillion. Would you mind buying some from us?" And then they said, "Yeah, we'll take the whole thing down. Thank you very much." So, yeah, it's par for the course. And I don't really make anything of it. I see that as noise, and I just watch it as noise because the Fed ultimately is going to, you lose credibility if they're too loose. And I personally think Powell, most of the time I think Powell's not doing the right thing, but right now I think he is. I think he
By sitting tight, you mean?
yeah, being just not loosening. I don't know that he's tight, but he's not loosening. So I'd like to see another 6-9 months. I was just having a conversation with a bunch of other professors here. We just did our Friday paper. And I was talking about the nonsense of the 2% inflation target. So the 2% inflation target came from an economist down in New Zealand Central Bank. And there's nothing to back it up that says this. If you have a 2% inflation rate, you're able to maximize economic output and wealth creation. There is no such paper. There's no such evidence. So, but I think it's amazing that the whole world glommed on to a number that somebody just went, 2% looks pretty good to me. Let's go with 2%. And my second thought on that is 2% is not really the target, it's the floor. Because listen to the discourse. As the inflation rate comes down from 3 or 2.8 or 2.7, whatever it is, everybody's going, well, it's coming down. The Fed can start loosening now, which means the average person, whether political pundit or financial media person, they're basically saying got to 2%. We can juice the economy now. So to me, 2% is a floor, and if you're thinking about being a bond investor, you should think more in those terms, and let all the sort of discourse um, flow over your shoulder. It's going to be there no matter what, and that's my view, and that's how I kind of think of the world.
Yeah, I mean, I know that you've also done, an analysis of prices and inflation going back hundreds of years, actually, going through periods of war. Most of that time that you've examined, when we're looking at inflation rates over the course of this country's history, so dating all the way back to the Revolution, exhibited a familiar pattern, which was that, generally speaking, because there are different ways to create inflation, and wartime tends to be inflationary, because often what goes on is there's excess borrowing. Governments borrow a lot of money to go to war. That's the first thing that happens. The second thing is that resources are reallocated
Yeah.
to the war effort. So prosecuting a war has its own demands for goods and services that may be different than what a peacetime and healthy economy might need and enjoy, and consequently, that reallocation might create short-term supply-demand imbalances for goods that are not being produced in the needed quantities necessarily, and the prices of those things might rise. But the history has demonstrated that when you have something, some form of hard money underpinning, that once you get the debt under control, generally speaking, periods of wartime inflation are followed by peacetime deflation back to some sort of stable level. And that basically was the history all the way up until the 1900s in World War II, where we took on massive amounts of debt to prosecute that war. And we just decided we were going to be a debtor nation ever since.
Yeah. We made no attempt to reduce debt. The only thing that falls from time to time.
We did in the 1990s, I think.
Yeah, but it fell because the government was counting the Social Security surplus as a surplus and offsetting the deficits they were running in the regular portion of the budget. If we had honest accounting with Social Security, it should be its own thing. Money coming in, money coming out, and there's a pot of money being invested to get a return on that money to make sure that people get their benefits. That's how a regular run-of-the-mill pension plan works for every corporation in the United States, defined benefit plan. And we have what's called a unifying budget. I think that was done by Johnson in 63 or 4 or 5. I forget the year, in the early 60s, where they just merged the two budgets together because we were running a budget deficit back then. And that was one way to make it look really small. And we've kind of been stuck with that situation ever since. But yeah, to Bill Clinton's and Newt Gingrich's benefit, or kudos to both. They did at least net not increase public debt outstanding, and that was a good thing. And so that was the one time two parties got together to do the right thing economically.
I think my own view of it is that I sometimes believe that's the necessary way to do it. You have to have a bipartisan effort, because it is, trying to fix the deficit problem involves some pain. And it's far easier for a party that is not in power to point the finger and blame the one that is, and say that, the pain that you're currently feeling as a result of some measures of austerity, which could come in the form either of hiking taxes, reducing spending, some combination of these, reducing even just the promises that are being made about future benefits, those types of things. And that was probably the reason that we had that success. We had a Republican Congress, and we had a Democrat in the White House. And I think that was one of the reasons they were able to do that. So, with that cheery subject,
Move on.
moving away from Powell and the monetary issues. I mean, my own view is that I felt like Nixon. The last thing I'll say about it is I think that Nixon, the general consensus is that Nixon was effective in pressuring Arthur Burns, and because he was, that helped contribute to the inflation that followed.
Yeah, Burns was a very loose monetary policy guy.
Yeah, and that proved to be an exceptionally painful thing for the country. So I applaud Powell for not bending over for Trump or for anyone, frankly.
Yeah.
And I'm glad that when he looks at the pictures, the oil paintings on the wall at the central bank, that maybe he looks to somebody like Paul Volcker before he looks at Yellen, Bernanke, or Burns.
Maybe somebody should send
his
him
model.
A box of cigars.
Yeah, right. And some platform shoes. Volcker was a really big guy.
Yeah, he was huge, and he's the only guy I know that ever sat in front of Congress smoking a cigar about this big. Just to let everybody know who was the boss.
He looked every part the banker.
Yeah.
So on the tariff front, that was the other issue that gave stocks a boost this week.
Yeah.
So we had some sort of conciliatory tones coming from Washington. They are insisting that they're having conversations with China. What do you think the chances are that these conversations are really making any progress, though? China is, sort of saying, "Hey, we don't like the way you're negotiating, and we're not going to have it."
Yeah. Well, this has been various administrations have tried to negotiate deals with China, and China is very good at passive aggressive negotiating tactics, where they say, "Yeah, okay, yeah, we're going to change," stuff like that. We're going to we'll have another meeting next month, and we'll work on some details. And oh, you know what? You guys just had a new election, and there's a whole bunch of new people there, and they don't pick up the flag and keep running. So the Chinese
start over.
They've been doing that for 20 years.
Yeah.
And so this is a different tactic where they're kind of using a sledgehammer. It's an ugly process. I think ultimately there will be some good changes. I would like to see certain things, not only like subsidies to their industries and stuff like that, but if a Chinese company can own 100% of a U.S. company, then U.S. companies should be able to own 100% of a company in China. And today that is not the case. I think the only exception to that is Tesla. I think they own their business, but I don't think it's my understanding that some Chinese corporation or Chinese national owns 51% or more of every U.S. company in China. And that precipitates a pathway for intellectual property to go to the government and to local businesses and local companies. And so there are more things going on that I would like to see fixed as well, that I think would be, better for everybody. But, I kind of think of China's, the CCP, is they run the Chinese government like a corporation, in that their goal is to maximize profit. And the way they measure profit is a trade surplus. That is net money coming into, profits coming into the country, which has helped them really build out their infrastructure, which is, let's be frank, their infrastructure is a heck of a lot better than ours. And their cities are cleaner, their trains are faster and more reliable. Their airports are fantastic. So they've done good things with it. But I would like to, see a number of things done. I'm hopeful. I'm not as worried about tariffs. People want to say that tariffs are blanket inflationary, and I don't think that is the case, because as um, Milton Friedman used to say that inflation is everywhere and always a monetary phenomenon. If our money supply stops growing, then we're not going to have inflation. Yes, products that come from China will be a higher price, but all of us have a certain amount of money that we can spend. And so we're going to spend less on other things, right? Because we'll have less money to spend. Some things will go up in price, other things will go down in price. And the overall price level is not going to change very much. At least that's my view. And, I'm waiting to see data that proves me wrong. But I think that's how this is going to play out. I don't think we're going to see some big boost of inflation. And I think the other thing that'll happen, of course, is people will buy less of those products that are subject to a tariff until all this blows over. And I don't see it as being this way 6 months or 9 months or a year from now.
I'll say with respect to China, authoritarian regimes generally, and communist regimes specifically, places where the people who govern a country do not face elections, don't have to play by the same rule set when it comes to international negotiations that democratic societies like ours have to, because they don't need to worry about being voted out of office. And in fact, in many of these places, the leadership of those countries have imposed significant hardship on their populations in advancement of a specific agenda. This was true under Mao. It is true under Kim Jong-il and then successors, Kim Jong-un now. It was true in Castro's Cuba. It was true in the Soviet Union. Oftentimes, the people who lead these countries will impose significant pain on their populations and can do so for prolonged periods. And that's it. So Xi is going to be looking out for the interests of China. A trade surplus is in China's interest. But, bending over for Trump is not in Xi's interest.
No.
And that's so it seems unlikely to me that they are going to be interested in anything that has a material optical benefit to the United States as a part of what's going on here. It's not really in Xi's interest. Whether it's in China's interest or ours is another matter. And of course, he can wait us out because he doesn't have to wait until the next presidential election. Sort of only has to wait for the midterms or until Congress decides, you know what, we're going to take control of the tariff situation because we don't like the way it's going. And if that happens, then I think that's a very difficult negotiating position for the United States to be in. I wanted to bring up this one item because I've heard people discuss it. The administration has talked about eliminating income taxes on people who make less than $150,000 a year, and that income tax elimination was going to be funded by the tariffs that they were talking about. So for anybody who's watching this, I just, somebody had come up and maybe someone on the production side can take a look and identify who it was. Somebody said, that doesn't work. You could never pay for it. I just wanted to make the following point, and as all will know, I like to use, round numbers because I think it keeps the math easy. So you'll forgive me if I round to the nearest tens of millions in terms of taxpayers, if I round to the nearest, 100 billion or so when talking about the trade deficit, and if I start talking also about the percentages of income taxes paid by various groups. But here are some numbers to think about. And people can go and look for some of this information on your own. There's a lot of very good resources. The U.S. National Debt Clock, which is funded by the Peterson Foundation, is very good. The Tax Foundation is another organization that I think does very good work. And there's a lot of other information where you can see who's paying what. I want to also do one quick level set before I get into this, and then we're going to start talking about meta earnings, and I'm going to get Mark's opinion. But it's important for people to understand that when we talk about taxes, income taxes and employment taxes, Medicare taxes, I'm not talking about all of these as one thing. When people get their paychecks, they see that money is withdrawn. They usually think of those as income taxes, or they often do. And they're not distinguishing between the employment tax contribution from the employer or the one that they have to make, and so on. So let me just talk a little bit about some things that are going on here. We import a little over $4 trillion worth of goods, and we export about $3 trillion, round numbers. So if we imposed an incremental tariff on those goods of 10%, assuming that the amount that we imported did not decline, which is probably not accurate, but let's just say that we did, that would represent about $400 billion worth of tariff revenue. If it declined, let's say it came to $3.5 trillion of imports, so we imported slightly less. Maybe we have no incremental net exports. So we improve the trade deficit by, let's call it $500 billion, and we're still collecting an incremental 10% in tariffs. That's $350 billion in revenues. It may surprise people to learn that $350 billion in revenues would indeed be sufficient to offset the income taxes paid by all income earners in the United States who make less than about $100,000 a year. And if you're wondering, well, how is that possible? About 100, and again, I'm using round numbers, about 170 million Americans file taxes each year. About 110 million owe income taxes each year. In 2022, the total income tax revenue to the federal government, I believe, was in the neighborhood of about $2.5 trillion. Again, you can look this up yourself. I think 2022 is the last year that we had this. 87+% of that number was paid by people who made over $100,000.
Yeah.
Okay. So again, and it's actually more than 87%, but 13% of $2.5 trillion is $325 billion. So that is less than 10% incremental tariffs on $3.5 trillion worth of imported goods. And that's assuming that you lose, we'll call it 12.5% of your imports as a result of tariff increases. So essentially, you could indeed eliminate income taxes for everybody making less than $100,000. The bottom half of income taxpayers collectively only pay 3% of the entire income tax revenue collection. And I actually think that would be okay with me, in part because we would be able to eliminate immediately. Now, there is a moral hazard here. When people look at this problem, one of the things that they often say, well, we have to tax the rich more, we have to do this and that. We do have a very progressive tax system in the United States on wage earners. I want to make this very clear. So that's, people like Mark and probably a lot of the people who are watching this. Anybody who receives a W-2. If you are in the top half of W-2 earners, you are carrying the load in terms of income taxes. Because the very wealthiest, typically their wealth does not come from salaries. Now, if you're Jamie Dimon, somebody like that who, gets really big checks, there's a handful of major corporate executives who receive very large wages. You have people like that. But the wealthiest typically are getting wealthy in the way that Elon Musk does, or Warren Buffett does, or Mark Zuckerberg does, or Jeff Bezos, or Bill Gates. The list goes on and on. I think Elon Musk doesn't collect any W-2 income from his companies, or it's some nominal amount. I think Warren Buffett and Charlie Munger were paying themselves $100,000 a year for a long time. They were paying many of their employees more than that. And in fact, so much so that Warren Buffett would say that his, people who work for him paid higher taxes than he did. You should therefore hike the income tax. the little sleight of hand that went on there is that he isn't collecting income. So really what he was doing is he was saying, they pay more taxes than I do. Make it even higher.
Pretty
obviously
sneaky.
love and respect Warren, but that sleight of hand often gets missed by people who discuss this.
Yeah.
So I wanted to just make that point because I think it's kind of interesting, and I like to throw out little bits of data, and people can go do their own work on this. But I think you'll find that if you explore this topic a little bit more, it gets very interesting. All right, so let's talk a little bit about Meta. Meta is going to be reporting. You and I talked a little bit about this. What are your thoughts on Meta going into earnings? So they're going to be reporting on the 30th, I believe, after the close.
Yeah, and I think expectations are about 5.25 a share. Does that sound right?
It is. Let's take a look.
And I think that's up. If that number is right, then I think that's up about 50 cents from the first quarter of last year. So a little bit of
yeah. Let me
earnings growth
just
there.
I'm going to do a quarterly drill down. I'm going to go over here to stock data so we can have a quick peek. Excuse me, Ticker Explorer.
Yep.
We're going to have a quick peek at the earnings for Meta on unusual whales here. We can have a little.
And anyway, if I think that if that number is right, then I'm looking for them to hit expectations. Possibly, if it deviates, that'll be a small beat. That's my expectation. They've got a great business. They can manage their income statement a little bit by how fast they're spending on CapEx. If they slowed that down, then there would be a little less depreciation. So I'm going to be willing to bet that whatever guidance they've been providing that gets to that number, that they're going to meet it. They have possibly sandbagged a little bit. But I think they're going to hit expectations. And you've got a chart up there which I can't read. My eyes aren't.
So I'm going to just show this because I think this is kind of interesting. The reason I wanted to talk about Meta was there's two things going on here. The first is that this is a stock that is down significantly this year so far, like 27%. And as people who are watching will know, one of the things about the market pullback that I have thought was kind of interesting is you have people pulling out of Mag 7 names. You have people who are overly concerned about the CapEx on the AI side. And there's a precedent for this in Meta's case specifically, which I think is kind of interesting. And I wanted to show on this top chart here. So the green dotted line that my cursor is currently following, that is the average Meta price performance coming into earnings over the last 3 years. Okay, and the red line here, and it's only red because the stock is down, this is the price path that Meta has followed this year so far going into earnings. So it's underperformed on the year. It's underperforming the market. It's down, it is in its own little bear market here, and it's underperforming its own history. And I think that could present arguably a bit of an opportunity. Now, the reason we're talking so much about CapEx is because I want to highlight one thing as we think about this, which is that most people who are looking at these companies that are investing massive amounts in AI, and the full year CapEx spend for Meta is, let me just take a quick peek. I think it's like, we were talking about it right before we went live. I think it's 60 billion, round numbers again. So the street's estimate is 59.4 billion. So we'll call it 60 billion bucks. To put things in perspective, before they really started doing the AI build out, their CapEx was probably 20 billion a year. Went up to 30. Now the reason I say there's a precedent was because people who've been following this company for a long time will know that Mark Zuckerberg got very excited about the metaverse. That's why they changed the name from Facebook to Meta. And they were making massive investments in the metaverse. And he controls the company. So, he's the technology visionary for it. So if that's where he's going to focus his time and attention, that's where the investment and money will go. Whether it's a good idea or a bad idea, only time will tell. Now, why do I bring this up? Because the metaverse didn't turn out so hot. I think, how did you describe it right before we went on?
Oh, I forget, but it was a black hole.
A big donut. You said it's
big donut,
a big donut.
Yeah, I don't, I think they just had to write the whole thing off. Although they're still doing stuff in that space. They're still making some glasses to operate in the metaverse. So they're doing something there and continue.
And glasses that you can wear around in the real world.
Yeah,
and
regular, not these big old goggle things. Yeah.
Yeah. Mm-hmm.
So that'll give you a neck ache.
So this is what I want people to think about here, okay? So even net of these massive investments, so the company is going to have probably year-on-year revenue growth of 13, 14%-ish through the end of this year, okay? They're going to generate probably $42 billion worth of free cash flow, and that's net of that $60 billion worth of CapEx. Remember what happened with the metaverse. Now, if that had really panned out, he would have looked like a huge hero, and everybody said, the visionary did it again.
Yeah.
Okay? It didn't turn out that way. AI, time will tell.
Yeah.
But the point I'm trying to make here is that if the pace of monetization for these investments doesn't prove to be that exciting to investors, if you have a long-term view, I want you to consider that, first of all, the cost of these technologies is probably going to drop because they are very dependent on a handful of suppliers now, like NVIDIA, which has a 74% gross operating margin, which is, to me, unsustainable. I think that they are ultimately, there either will be some competition, or demand will fall, or new technologies will come up where they are able to essentially achieve the same results. And we have quantum computing, which is probably 5-6 years out, maybe, hopefully. But my point is that what happened in the metaverse debacle, if we want to call it that, once they realized that the investment wasn't paying off, they pivoted. Yeah. That's the thing. They can make these kinds of changes. It's not a bureaucratic organization because, again, it depends on one guy. And if he says, you know what, I don't like this, we're going to stop, they can turn the cash flow spigots up. So think about this. Let's advance the clock a couple of years. Let's go to 2027 and imagine what the world looks like. At the 13% growth rate that we're currently seeing in the company, we're looking at about $240 billion in full year 2027 revenues. 80% gross operating margins and an anticipated CapEx of about $66 billion, still netting you to $70 billion in free cash flow. This is it's a $1.3.5 trillion company, okay? So that's $70 billion over $13.50. So 2027 free cash would be about 5.2% of the current enterprise value of this business. But if they decided, you know what, this AI investment's too much, let's pull it back by $20 billion. So, or let's make it $25 billion because it actually makes the math easier. $25 billion reduction in CapEx is an incremental 2% of free cash flow to the bottom line. Right?
Yeah, so I just had a student walk in and I had to chase him out. Sorry.
They could always hop on the camera.
You're exactly right. They can cut that back. I think they will. But I think there's something interesting going on where I think building out AI for Meta is an offensive move, but with Google, it's a defensive move. And the reason why I think that is that there are lots of people like me that used to use Google a lot to do our searches. Now
I was one of those. Google everything. It's like using a Kleenex. It became the word to describe how you went for answers.
That's right. It was sort of like making a Xerox. And I don't use it that much anymore because I use AI to do my searches. It answers the question, and then I get references, and I can go click through to the websites to go see. So I'm getting it an added benefit. So instead of getting a list of things to go check out, it's summarizing all that stuff for me, and then gives me a link to go check out the sources so I can double check that what I'm seeing is good. So I think in time, Google's now in a position where the traditional search business is going to shrink super fast, and so they are in a race to get their AI capabilities up so that it replaces, the search business. That's why I say they're playing defense. Search was not a big part of Meta's business. So I think this creates another vector for them to generate revenue, and so I see it as an offensive move for them. And I think net, I just think if I'm looking at those two companies, I think the ROI is going to be better at Meta than it's going to be at Google.
So, this is interesting. Do you use Gemini at all? Well, first of all, you use AI. Do you use the paid versions, and which ones do you use?
I used Gemini for a while, and I didn't like it. I use a paid version of Grok's and Perplexity. Those are probably my two go-tos.
Mm-hmm.
And because I'm happy with what I get when I click through and I take a look at the sources, I'm getting answers that I want. I'm sure I'm missing out on some that are probably doing equal to or maybe better jobs. But those two are working for me, and I don't get too many what they call hallucinations, which are just like made up stuff, where the algorithm goes a bit wobbly. But I don't. Those are the two that I use. My primary use.
It's interesting. So, I mean, I do still Google things. They are using some variant, I believe, of Gemini for the answer that populates at the top. So if you Google something, two things happen. The first is the conventional search engine, where it tries to identify websites that that their algorithms believe most closely aligned to whatever it is you're looking for. But it also proposes an answer to the question it might assume, which I'm assuming is using Gemini's large language model. I, at the moment, for my own sort of research, use ChatGPT, paid version, and I toggle between the different models that they have. We could bring them up if we wanted to. I don't know that it's that important to do so. Gemini also, partially because I use Google Business Services for some stuff, and so that was a nominal tack on.
Yeah.
Grok, because I'm also a paid user of X, so that also was a nominal tack on. And that basically is it.
Mm-hmm.
Producer Jay, who is behind the scenes right now, was using an installed version of what was that Chinese one? Drawing a blank. The one that caused all of the tumult in February when they announced that they did this large language model training for $7 million or $5 million, some really paltry number.
So he uses that in an app as opposed to web?
He has an installed version on a dedicated machine just to play with it.
Oh, interesting.
So, I think I agree with you that because Google search they dominate search. They are, when it comes to search, they own that space.
Yeah.
And this is a little bit of a problem because my acronym at the beginning of the year was RISING, RISINGG, for viewers of this channel. RSP equal weight S&P instead of the the cap weighted S&P 500. I was just because IBIT is an ETF that tracks Bitcoin, and for people who don't have their own way to do that, that's an easy way if you just have access to equity. But the two G's were for gold, but also for Google.
Yeah.
And that's turned out miserably.
Yeah.
That was and my logic on that was that, first of all, the street has a chronic problem, in my experience, or has had, underestimating revenues. There's always this fall off. It was going to be ad spending, for example, is usually the big thing. People say, ad spending is going to come off. And so we had this kind of chronic underestimate on the revenue side. And in fact, Google has typically done quite well on that score. And now they've got this antitrust issue, and that's presenting its own problems. But and this brings up another thing which I think is worth saying. what percentage of the S&P has reported? So I was looking at this 2 days ago. 25% of the S&P had reported so far when I was looking at this. It's more now, of course. And we're now up to... So we're up to... What do we got here? S&P 500. 35, almost 36% of the S&P is reported as of right now. Of those, it looks like 48% actually had a positive revenue beat versus street estimates, and another 20% were in line. So you put those two numbers together, you get 67% of the 36% of the S&P that have reported were either in line or better than expected on the revenue line. 75% actually had an earnings beat, and another 4.5, give or take, were in line. So that means roughly 80% of the S&P that is reported so far either meet or beat, and most beat earnings. Question for you. What do you think that's a good number, a bad number, or meaningful, or do you think that where we're going to see the hair is likely to be Q2 earnings?
Well, people have been worried about a slowdown for quite some time. And so I don't, I think they're good numbers in the way everything has come in. I think it's harder to have recessions or severe recessions in the U.S. because we're so service oriented as opposed to manufacturing with a supply chain and it helps to drive a business cycle. So it's less muted. I think the rubber is going to meet the road when we see Q2 and Q3, because the tariff issues haven't caused anything, and frankly, it won't cause too much in Q2, even if it goes on for a long time, because there's so much product in the supply chain that it just takes a while for that to get all the way through. If there's going to be a problem, and this goes on for a long time, then supply chain issues, I think, prop up in about 3 months. And then maybe it starts to show up in Q through 3 earnings. And so I think there's pressure on everybody to compromise. And I'm optimistic here that there will be a compromise. I think one of the winners of all of that might be Europe, because they're not putting on tariffs, and so China will have all this excess capacity, and they'll want to sell products at lower prices to keep their volumes up. And so actually Europe might end up being a beneficiary of this in a short-term period. That's an aside. But net, I'm still positive on the economy. I'm also still of the view that equities are too expensive when you compare the market cap of equities relative to the size of GDP. We've shown that chart on this show a couple of times. And so I can see stocks not getting obliterated, but trading sideways in a big choppy pattern for a while.
Some of the Mag 7s, though, I mean, aren't the Mag 7s getting to be a little bit more reasonable in here? I mean,
yeah.
The thing is that so before all of the hubbub, the S&P was trading around 24 times forward.
Yeah.
Long-term mean is 18. Bear market troughs are closer to 14.
Yeah.
We got down to 20. Take a look at, when you look at companies like, so Google's got its own, Alphabet's got its own sort of problems. Meta is currently trading 20 times full year estimates right now in round numbers. Next year's numbers, it's trading, let's just call it $5.50 a share, and we'll call it 30, 18 times forward.
Yeah.
On a 4% free cash flow yield. I feel like people are backing out of, these quite good and growing businesses. And, these things were rich. I mean, it was trading.
They were rich.
But they're not as rich now. I mean, that's what happens when stocks go on sale. The stock falls 25, 30%. Yeah, it was expensive. Maybe it's not expensive. I mean, it's like if you go and you look at a Toyota Camry, and the Toyota Camry, and you say, "Oh my God, the thing is $35,000. It's ridiculous." But if it, 30% off of 35,000 is a big, big discount. So if you suddenly start saying, "Oh, okay, well now this thing's got 24 grand," it can become reasonable. I mean, to me, Meta is reasonable. Netflix was reasonable, and that brings up our question. So Finwest said, "Happy expiration Friday, guys." Mike, if memory serves, you did a trade on Netflix last week. How did it turn out? Yes, indeed, I did. So, a couple trades actually to talk about Netflix. So, number one, people will know that I often refer to Netflix as a kind of an unregulated utility. It's the last thing, I believe. You and I both talked about this. It's the last thing that consumers are going to give up. And in fact, consumers, as they give up other things, will become more dependent on Netflix than they have been. And the interesting thing is that if they increase their hourly watching of Netflix for those that have the ad service, that increases the company's value even if they don't pay another dime. All they need to do is keep their eyes glued to that screen a little bit longer. Netflix wins. And so I think that's a benefit. So what do we do in Netflix? People will know that the unusual thing that happened last week was that Netflix reported after the close, and we had Good Friday. Market was closed on Friday, which meant that you had options expiration coinciding with the earnings release. Now, the point I had made, because I'm generally bullish, was that if you were looking to hedge it, you could trade a tight fly where you bought a downside put, sold two on a strike that had a lot of downside open interest, below where the stock closed, and then buy one below at a very low price. I paid 10 cents. 10 cents a share to put that thing on.
Nice.
Okay. Now, the idea was, if the stock falls, exercise the two long puts, and maybe I don't get assigned on the short ones, and I get essentially a cheap hedge on the long equity, if I get away with it. And the logic of that was that some retail holders who may have bought those options in anticipation of a decline that didn't come, because the stock was trading in the low 900s early in the week, and it was 975-ish, going by memory, as of Thursday's close. So that was the trade I did. And I was only going to exercise, of course, if the stock fell after earnings. It didn't say that I was expecting it to fall. I'm just saying if it did. Now, I also advised a friend of mine who I used to work for, actually, when I was at Ivory. Netflix is his single largest long holding. And he was down in the desert, down in Palm Springs, playing tennis or doing whatever he was doing. And I said, hey, this is an idea. He liked the idea, but as we walked through it a little bit on Thursday, we recognized that there was a problem for him. And the problem was that he's been a long time Netflix shareholder, and he has a low basis. So in a taxable environment. And what that meant was that the stock would have to fall a huge amount for him to actually be interested in exercising puts, because if he sold the stock at a strike, he was going to have a huge tax bill. So he's kind of locked into it. So he actually played it the other way. So I said, okay, well, I guess you can't hedge. You can't, because he's like, I don't want to sell any stock. Whatever happens, I don't want to sell any stock. So you can, if in that circumstance, if you ever find yourself in that circumstance, you can buy puts and monetize those puts if the stock declines, and never exercise them, right? But if you're in his situation where you can't be in a situation where you might either exercise and sell stock, or be assigned short calls and sell stock at a highly appreciated level, important.
So
that's
did he Texas hedge then and bet to go higher?
So what he did was he actually traded upside call options. And the logic was, if earnings come out better than expected, and earnings were good, okay, so Netflix numbers were really quite good. Top line beat, bottom line beat, slight miss, I think, on the free cash flow side. Then you exercise the calls. I think he may have owned 980s or something like that. So the stock, again, was like 975. And if the stock goes higher, then you exercise your long calls and hope you don't get assigned on the short side.
Yeah.
Now, it actually was a fairly muted move. Let me pull it up. Because the stock traded up to, I'm going to get up to like 1040. I was watching it very closely after hours. I think it got up to, it was, like 1040. He ended up exercising calls. He ended up in a call spread, so he made a couple extra bucks. He bought some lower strike calls, got assigned some higher strike ones, and he had put that thing on for very little money. So he got, made some money.
Okay, good.
Not a lot, but made some money. And now, of course, the stock is substantially higher. Where are we now? So
What's the break even on Meta? The break even move.
7.8, something like that. 7.8%. Let me double check. I'll just give it to the end of the week. So May 2nd at the money straddle. I'm going to use the 550s.
Because I was just wondering about that. I don't know how people are feeling about it going in. I don't know if people are as optimistic as I am. One of the things I talked about, and you talked about maybe the indexes being okay because the Mag 7 has gone down, but well,
I'm not about the index. I'm just saying some of the Mag 7 stocks, like Meta, seem reasonably priced.
Yeah, no.
And I'm looking out to end of year 2027, just so everybody knows, because earnings could come out and they should say, oh, we just spent an extra $5 or $10 billion in CapEx on AI investment. And a lot of the street's going to say, we hate that because everybody's balking about overspending and no monetization.
Yeah.
I actually don't look at it that way. I'm looking at a business that can generate massive amounts of free cash flow, that is growing its top line. The things I care about, is the top line number going to be good? And, how do earnings look? The CapEx, this is not like you run a hotel.
Yeah.
If you run a hotel, the thing gets run down. You've got to invest money in your business, or you have your assets are actually just going to crap.
You don't get to.
In Meta's case, they're making an investment in a hypothetical technology exercise that they believe is important for their business. Maybe it is, maybe it isn't. I think it is, so I think they should do it. But I'm not. If the revenue came in light, that would worry me a lot more than the CapEx number. I think people rant and rave about the CapEx a little too much.
Yeah, the point I was going to make is at 7-8%, I don't think there's something compelling to do with earnings. The same way that you had a nice, interesting idea with Netflix. And going back to my point, that the thing that worries about me with AI is, I don't know what the number is, but what has the industry invested? 300 billion, 400 billion. I'm going to guess that the returns on that, they're not going to have positive returns on that for a few years, at least a year, but maybe a few years. But my larger concern is that, they've got a cost of equity capital of 10 or 12%. Those investments may not give them any more than a couple of percent. And that's why I think that the indexes may be fully valued. And a lot of these companies will just trade sideways as as people kind of figure out where the business model is going to go. How are you going to generate the quantity of revenue needed to get a 10 to 12% return on investments on whatever $300, $400, $500 billion that has been spent here already. Because remember, it's not just chips, it's not just servers, but it's building, it's air conditioning systems, it's power plants. The investments across the scheme are really enormous, and they need to find somebody to sell those services to in sufficient quantity to.
Well, your estimate is probably in line, and let's just back of the napkin this for just a second. So to your point, it is not just NVIDIA GPUs where people are making their investments to build out these data centers and everything else associated with it. So that's the hardware side. There's more to it even just than hardware. But leaving that alone, 400 billion is probably the amount that NVIDIA can count as revenues from 2022 through the end of fiscal year 2026. I say fiscal year 2026 because fiscal year 2026 is really this year.
Okay.
Because their calendar year ends at the end of January. So that's the year we're currently in. So NVIDIA alone, I would say about $400 billion of their revenue is associated with the AI build-out.
Okay, so the industry build-out's probably 800.
Yeah, it could. Well, I don't know if it's 800, but it's obviously a bigger number than that.
Yeah.
It's not NVIDIA plus 25%. It's probably NVIDIA plus 50%, right?
Yeah.
So that's $600 billion through year end. That's a big investment. And to your point, it would need to translate into something pretty enormous. But, there's all kinds of things for the technology companies that they can use they can optimize their pricing and targeting for advertising in the case of Meta and Google. They can use this technology on their expense side. So everyone's like, oh, when are you going to get revenues from it? Really? These businesses depend quite a lot on coding.
Yeah.
And AI is doing a lot of coding now.
Yeah.
So,
maybe the same.
There are all kinds of ways that this investment can turn into money for shareholders.
Yeah.
And I think that people should probably be more patient. I know that I often, like you, I always have this, I get very excited by new technology, new developments, robotics, full self-driving, AI, you name it. These Neuralink, Starlink, all these things excite me because I believe that they actually are going to improve the world we live in. And I believe that some of these things are going to be transformative. Mm-hmm. And there's a lot of things that I haven't talked about because I'm not the visionary. I'm just the observer on the side, seeing what the visionaries come up with. But that has been the history. Yeah. For over a century, the United States, has seen the world, really, but the United States in particular, we've had massive productivity gains and quality of life enhancements that have come from developments. We don't know what they will be, but we know that they will.
Yeah.
Right? I don't know 100% that Meta and Zuckerberg are going to be the ones to take advantage of it. I don't know that for sure that it's Paige, Brin, and the rest of the gang over at Alphabet that are going to do it. But they're in a pretty good position.
Yeah.
They're continuing to invest in their businesses. They're not, one of the things that has happened in the American experience with business is that sometimes large manufacturing businesses atrophied. They rested on their laurels and they did not invest. And, they became big marketing engines operated by, people with MBAs, not masters of science and, the kind of experience that you have. General Motors would be a good example, right? So to me, these companies are doing the right thing. Whether it pays off, I don't know. But, if you bought a trading company, you wouldn't, if they were really profitable in the past, you would say, okay, if you were an investor in Jane Street, you wouldn't say, oh, well, I don't want you to take any more risk. Mm-hmm. That would be crazy. I mean, that's what they do. That's how they,
fair enough.
If they don't do that, they will be replaced by somebody who will.
Yep, fair enough.
Okay, let me quickly see if we have any other, if we have some questions here. So that was the Netflix thing. Viewer question, I did a Netflix strangle swap long. Okay, yeah. So that was from last week. So anybody who did a strangle swap probably did pretty well in Netflix. Mm-hmm. That was, that turned out to be a good trade. FinWest also reminded me, as did Steven, when I was like, what is the Chinese company? DeepSeek.
DeepSeek, yeah, there you go.
Yeah, it was deep something, but whatever, I was having a little,
all right,
mental bump there. But I know you have had a parade of students knocking on your office door, lots of questions. Your tests are too hard, Mark.
Yeah, well, I'm proud of that. We're starting to have finals next week and the week after. I'll be giving finals, so now everybody's sharpening their focus.
I'm sure.
Need one extra time. So yeah.
I have a question. So how many students would you estimate you have in total?
I can figure that out. About 175.
Okay.
I'm teaching 5 classes this semester.
Okay. And of the 175 students you have, how many regularly come to see you? And is it the same people? Do they come?
It's generally the same ones, and it's probably about 25. 20 to 20.
How much better is the grade on average of the subset that comes to see you versus rest of students?
It's certainly better. One of the things the kids don't understand is if I never see or talk to them, I don't have any basis upon which to give them the benefit of the doubt. So like if they're in my office all the time, I get an idea of what their knowledge base is. And let's say they're at the cutoff between a B plus, a B and a B plus or something. If I have no idea, I'm not likely to give them the benefit of doubt, but it's a half a point, a quarter of a point puts them up into the B plus. If they spent a lot of time with me, I go like, I know they know that material. I'm like
they just flubbed it a little on the exam. So you don't get an A for effort, but you might go from a B minus to a B to a B plus.
Yeah. So exactly, it's because at the end of the day, there's you want to use your grading methodology to come up with a grading methodology, but at the same time, I'm trying to let the outside world have an idea of what the level of mastery of the material that I teach.
All right. Well, I know we've gone over our time, and the difficult part is that Running Donut asked us a question about trade desk earnings, which are coming up in 2 weeks. The good news for you, Trading Donut, is that earnings are coming up in 2 weeks. And I actually thought that Trading Desk was looking like an increasingly interesting opportunity because that is another one of those uber growth stories that had fallen so sharply that maybe, just maybe, it was starting to get kind of interesting. And because I think that is probably a name that deserves some time and attention. Look at this, actually, although it's done pretty well lately. I mentioned this. When did I mention this? I think I brought it up on one of the live streams a little while ago because somebody had brought it up. Maybe it was you. So, yeah. And actually, as far as the debit spread is concerned, I think that the single stock options premiums, while elevated, aren't insane, particularly when you consider the whole complex. In fact, SIBO, Mandy Xu of SIBO, and you can get this research, I believe, for free. So if you go to the SIBO.com or if you just Google it. Yeah, you could use ChatGPT, Grok, whatever you want. They release, I think, weekly statistics on correlation, volatility, and dispersion. Dispersion is the thing that I'm referring to here. Dispersion was running at something like a 3-year high or something. Again, I'm just going by memory. What that is in a general sense, if you're looking at the S&P, it's telling you that the returns of the S&P constituent stocks are more dispersed than they have been. And therefore, the relationship, the extra premium you're paying in the earnings season might be worth it, especially if you can short a little bit of index vol against it. So, sell some Q vol, sell some SPY vol, and play debit spreads going into earnings on names that you like one way or the other. So that's the general thing, but Running Donut, it deserves more time and attention than we gave it here. We'll have to do a little bit of homework on it, and we will.
All right.
And we'll probably talk about that next week. All right, Mark, get back to your students. Have a great weekend. And everybody who is watching or watches this, thank you also for watching. Hope you guys enjoy your weekend. Like, subscribe, notification bell, all that good stuff. Give us a follow on X, and we'll see you next week. Thanks for watching.
Okay.